Well, hi everyone, and welcome to this week's edition of Feeling Smarter. As always, I'm joined by my co-host here, Tim Miller. G'day, Tim. How are you?
I'm going very well, Aaron. How are you doing today?
Not too bad, thank you. Well, we've just completed our SMSF Tax Planning webinar, and in that webinar, we naturally go through the various tips, traps, strategies, and other opportunities when it comes to your SMSF clients in the lead up to 30 June. Now, Tim, one of the areas of conversation, in particular since July of 2022, has just been around the older Australians. So that is the fact that we have the ability to make contributions now, member contributions through to age 75. So I guess before we get into maybe some of the questions more specifically, what are some of the important elements in the first instance here that we need to be aware with, where we have clients that are maybe either approaching 75 or once they are 75 from a contribution standpoint?
Yeah, so look, I guess the key things there, Aaron, is, and let's first look at the easy cohort. So those that are over 75 years of age, right? So once somebody is over 75 years of age, then it's pretty simple from a contribution point of view. They can either receive mandated employer contributions, which as we know is far less likely to occur in most instances, but can occur. And then the second one is downsizer contributions. So downsizer contributions can be made at any age from age 55 onwards, but there is no age-based restriction there for anyone over 75. So that's your simple approach. Then you've got those members who are turning 75. And they've got to obviously be mindful of what the rules are. So these are people that generally are 74 on the 1st of July during the year. So what are the rules that apply to them during the year that they turn 75? And ultimately, the way that the legislation is worded is it provides them with the capacity to make contributions, right, within or up to 28 days following the end of the month in which they turn 75. So realistically, it means that if you turn, doesn't matter which day of the month you turn 75, you've got 28 days in the following month to make your contribution.
Yeah, and this, I guess, leads us to the specific question that came about from our SMSF tax planning webinar, where we have the individual that has the high personal income, they're turning 75 in the month of June. So this is where we've got that crossover between the end of the financial year and then the 28-day period that you just touched on. And this is really here understanding the nuances between the way the rules work within the SIS Act and then how it actually applies from a deductibility point of view in the Tax Act. So the question here was, well, if we wanted to make a deductible contribution in the current year, so as in June, we could do that, but then could we also avail ourselves of a further deductible contribution in that subsequent year, ultimately being in that window where the individual has already turned 75, but we've not reached that 28 days after the end of the month, i.e. being the 28th of July, and the fact that that individual could potentially claim an actual tax deduction there. So I guess get you to unpack that a little bit because it's quite fascinating when you actually work through some of the machinations here that unfold.
Yeah, and look, and let's start with our original and initial approach to this and where this all stemmed from. We were discussing the concept of utilizing a contribution reserving strategy, so that the client potentially bringing next year's contribution into this year in June to claim a larger tax deduction to offset income this year, and then utilizing the adjustment mechanism with the tax office to be able to have that concessional contribution, the June concessional contribution, allocated to July for cap purposes, right?
Yeah. So just on that then. So what we'd ordinarily say here is that make the contribution in June and then allocate it to the subsequent year, because the work test issue is specific to the year in which the contribution is made. So as in FY 23-24 here. But what I guess you're about to also jump into is the fact that, well, we can actually satisfy the work test in the subsequent year, Now we're looking at, again, the nuance between how the rules work from a deductibility point of view and the fact that we have 28 days after the end of the month in which that individual turns 75 years of age.
Yeah, that's right. And so, yeah, so we obviously took the approach of utilizing contribution reserves, but then we said we would explore further the idea of this post 28 days following the month in which you turn from a deductibility point into the next year. And what there is, and really what's been tidied up since 2022 has been this collective merging of the SIS Act and the Tax Act around these contributions. So both the SIS Act provides for the ability to make the contribution within that 28 days following the end of the month. And then the Tax Act, when it's talking about tax deductibility or claiming a personal tax deduction, is quite specific in the wording under their age-based conditions for claiming a tax deduction. And it talks about if you, like, between the day you turn 67 and the day that is 28 days following the end of the month in which you turn 75. So the SIS Act and the Tax Act are well married together there to suggest that in the instance of somebody who turns 75 in June, so long as they make the contribution to their superannuation fund before the 28th of July or up to the 28th of July, then the fund can accept it in July. But further, they can also claim a tax deduction on that contribution subject to satisfying the work test in the financial year that starts in July. Now, of course, the key to that, Aaron, is that you might have to contribute by the 28th of July, but the capacity to claim the deduction is based on doing 40 hours in a 30 consecutive day period at any time during that year. So whilst it would be preferential, I suspect, in many instances, to ensure that that you're going to meet the work test in July to get the deduction, you don't necessarily have to. Now, the caveat to that is what I'm really alluding to there is if you think you're going to meet the work test after July and then you don't, then that amount's going to be counted as a non-concessional contribution. And if you've made other or utilize or bring forward contributions in previous years, you may end up with an excess non-concessional contribution point.
Yeah, and to that point, thinking about age 75, one of the clear strategies that is employed around NCCs and optimizing that, or maximizing, not optimizing, maximizing the available cap space that you have, is that in that final year before turning 75 and the 28 days, I guess, is that you can do or bring forward those subsequent years, i.e. being 76 and 77, without actually having to meet those subsequent years. And I know there was a lot of discussion at the time about whether that could apply or not. But again, it just comes back to the fact that the bring forward rule allows you to be measured against it at that point in time without actually looking at and understanding what age or what circumstances relate to that individual in the future. So to your point there, if we end up in a situation whereby the ability to claim the deduction is not satisfied, and the fact that we have an individual that makes that contribution before the 28th of July says, yeah, look, I'll go and find that work, due to ill health, then they don't actually achieve it. It gets knocked on the head. They may have made the 360,000 or 330,000, whichever the sort of the time frame that we're talking about there. Well, then we end up in an excess NCC position, which again can create some fairly significant problems for the client.
Yeah, so absolutely. So I guess in summarizing that, ultimately, if you turn 75 in June and you work in the following year, then you, one, can make your concessional contribution or your personal contribution, and two, you can claim a deduction on that, so long as you meet the gainful employment or satisfy the work test exemption. So for those clients that have less than $300,000 in their super fund at 30 June, let's use this year, 30 June 2024, they've got a total super balance less than $300,000 at 30 June 2024, and they make that contribution next year, then they can apply the work test exemption if they don't work next year.
Yeah. So, and again, there's a range of strategies that we can look to combine here and touch on. And I guess we've just touched on the timing of issues in respect to age 75, but the opportunities for catch-up amounts, or whether you're going to sort of maximize deductions in one year versus the other year, are all part of the advice process that people would need to work through. And I guess for those of you that maybe didn't get the opportunity to see our SMSF tax planning webinar, we do have the recording available, but also, Tim, we have a very comprehensive SMSF tax planning checklist that you will get as part of that recording. Of course, all of our members get access to this as part of their ongoing CPD subscription, but maybe just share a little bit of insight as to what people get out of that SMSF tax planning checklist as well.
Yeah, look, so what we've done is we've tried to work through all the questions that we suspect people are trying to look at from an end of year planning point of view, through all things contributions, investments, and benefit payments. And we've tried to sort of marry that together as a checklist, so that we can, one, work through each member of the fund to identify the key issues that we need to have satisfied by 30 June. And then subsequent to that, we provided a reference guide. So all those questions, if there's more information required as to what those issues mean, then we've got more information provided in our reference guide, as well as external links to both legislation, ATO position, case laws, and other reference materials, including some of our sample documentation that might be used, for instance, in such a matter like contribution reserving.
Absolutely. Well, thank you once again for joining us in this week's edition of Feeling Smarter. We'll have plenty more to cover in our upcoming sessions. Have a great rest of the day, and bye for now.
See you all.